I have a client who 2 years ago sold their business and they sold it in October. And which means that the tax bills due by, or they only have until December to get all their stuff in put together to save on taxes for the business sale. So their big mistake was they knew they were selling the business a year before that, but they did zero planning up to that point until they sold the business. And then they're scrambling to do their tax, like to put all their tax planning in place in the last 3 months of the year. And so they got stuck with not being able to take advantage of some of the different things you can do when you sell a business or having a liquidity event to do the tax planning ahead of time to save on those taxes. And so that's one I can think of where they didn't do their tax planning before the event happened.
Yeah.
They tried to do it after and they ran out of time.
Yeah.
So it probably, if I'm going back to that case, it probably cost them $2 million in taxes.
Wow. Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with you, we're invested in over 1,000 multifamily apartments under renovation, nearly 100 single-family rental homes under development, more than 350,000 square foot of industrial real estate, over 700,000 of private loans, nearly 40 oil and gas wells, and we've expanded to other asset classes as well, with the end goal of helping investors, you, create diversified, balanced portfolios. Before we begin, as always, quick disclaimer, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So please perform your due diligence before making any financial decisions. And of course, consult your CPA, your attorney, your financial advisor before beginning investments. I'm your host, John Lai, and welcome to today's episode, Tax Smart Wealth Building That Moves the Matter Most with Chad Taylor. Chad's a founder, principal of Sea Point Wealth Advisors, 20 plus year veteran of major brokerage firms, a former SVP of wealth management at UBS. After 2 decades inside the largest names of Wall Street, Chad stepped out to build a more personalized practice. One focused less on over-engineered complexity, more on the moves that actually move the needle for high earners and newly liquid families. Today, Chad's going to walk us through some real-world planning scenarios such as tax loss harvesting, what works, what's overhyped, asset location, where you hold your investment matters as much as what you hold, and then charitable giving strategies like donor advised funds, CDs, and the like. For those of us and our audience who don't know your journey, Chad, could you give our audience a brief history of how you got to where you are today?
Yeah, thanks for having me, John. I appreciate it. I'm happy to be on the show. Like you said, I've been in business for 29 years, which is hard to believe at this point. And I started back in 97 with Merrill Lynch, Mother Merrill back in the day, which is where you'd go to get your training and learn the business. It was a great experience for me coming right out of college. I had a financial planning degree from Texas State University. And growing up, we didn't grow up with a lot of money. And so I wanted to learn about money. And that's why I decided to get in the financial planning business, is to teach myself about it and to grow up in a better circumstance than I did when I was a kid. And so I got my CFP back in 2005, I believe it was, Certified Financial Planning designation, and a personal financial planning degree from San Diego State University. And after being in the big firms like you talked about for 20 plus years, I decided the next best path for myself and my clients was to go out on my own, to be independent and have more control over our investments and how we manage our clients' portfolios. And so we did that back in 2021, and we chose LPL Financial as our partner. And it's been great. Our clients have enjoyed the experience of being independent, and the more tools we can bring to them that we couldn't bring to them previously. And it's been a great journey for us. And we've grown substantially since we left and became independent. We now manage close to $400 million of assets. Myself and my company is close to about $750 to $800 million of assets we manage.
That's great. That's fantastic. After being in the large brokerage firms financial firms for 20 plus years and now running your shop at Sea Point, what's the single biggest mindset shift that you see high earners need to make about taxes?
Well, taxes is other than some of the biggest expense you're going to have, right? And when you're building portfolios and analyzing investments, tax is a major consideration. And the one question I get all the time is, how can we save on taxes?
Yeah.
And a lot of times if you're a W-2 employee, there's not a lot of things you can do, but you can make your investments more tax efficient, right? So when you're looking at a taxable portfolio, are you using ETFs, which are more tax efficient than mutual funds? They can control your capital gains. And one of the strategies I really like now is using what's called a direct index with a tax loss harvesting strategy. If you're not familiar with that, it is your own personal index, and every quarter or every month, depending on which company you use, they harvest losses inside your own index. And I use the S&P 1500 to generate losses. And so to think of it this way, if inside that portfolio, you own Coca-Cola and that quarter, Coca-Cola is negative, they'll sell Coca-Cola and buy Pepsi. So you're going to track what the index is, which is what you're trying to accomplish, but you're taking these losses that you can offset against your gains down the road. And it's been great. Last year, our portfolio was up with the market like 20%, call it 18, 20%. And we've had clients that had 60, 80, $100,000 in losses, even though they're up 20% for the year. Employing strategies like that and being tax efficient with how you build the portfolios, obviously muni bonds for income. But other things you look at too is, okay, maybe I have some investments that are yielding income. Maybe that's better off to hold my IRA where I'm not paying taxes on that, and have more equities in my personal account, which are more tax. They don't have as many dividends or distributions. The planning that goes around is what I think is what most people are looking for when they're looking at managing the taxes.
Yeah. In tax planning, what do you think actually moves the needle versus just noise? You spoke about a few tax strategies. People often like chase a shiny object rather than maybe something that's meaningful or makes an impact.
Yeah, I think there's a lot we get some very complex situations that come to us that sometimes you're just like, I don't know about that. This seems a little bit too risky with interpretation of the tax law. What I always tell my clients is you want the tax loss, right? You're investing in something to get this tax loss, but it still has to be a good investment. The underlying investment still has to be good. And so sometimes we see these strategies, either as an opportunity zone or, gosh, one of them was, I don't even remember, they're selling mineral rights and buying them back. It's like selling fertilizer and buying it back. I'm looking at this, I'm like, this is an audit red flag, no matter way you look at it. But their whole thought of it is we're going to buy this for a loss and it doesn't matter what the investment actually does. And to me, that's just not a good strategy. I tell my clients the tax loss needs to be secondary to be a good investment.
Yeah.
So I think that avoids some of the shiny objects.
Yeah.
And you also have to consider what's your audit liability. And so you don't want to take on some of these strategies to take a loss. And then next thing you know, you're getting audited by the IRS and you've got other problems. You got to be smart about that as well, too.
Yep. Yeah. We always say, don't let the tax tail wag the dog.
Absolutely.
Your dog.
Yep. That's exactly right. Yeah.
For someone, and this is our audience, a lot of our audience, W-2 employees, they know about 401ks, they know about IRAs. For that audience who built their wealth entirely or almost entirely inside a 401k or inside a brokerage account, are there uncomfortable truths that they need to hear? They always want to maximize their 401k, and that's what we're taught without that much more financial advice. What more advice could we give them to help break down this type of investment strategy?
Yeah, 401k is a great option, right? Especially if your employer gives you a match. That's free money for you. That's a free return if they're giving you a match on your 401k contribution. The one thing I say that people get in trouble with is probably not the right term. Because they save so much in their 401k, they don't save outside the 401k. So they have no taxable savings. And so when you get to retirement and you're starting to take that money out, you have no way to do any kind of tax management with taking money from a taxable account you've already paid taxes on and coming out of the IRA or the 401k, excuse me. Because everything that comes out of 401k is not going to be taxed as ordinary income. And so if you're not building up a personal savings in a brokerage account that's in your trust or your individual account that can help offset and blend your tax rate at retirement, you just don't have any flexibility. You're going to be stuck at whatever you need to take out. It's all going to be ordinary income. So that's one thing I tell people is, take advantage of the 401k, but don't neglect saving outside the 401k as well too. And some people don't understand how that works. And all it is, you open up an individual account or a trust account in your name, and you just put money aside and have your advisor start investing into ETFs or taxable, like the direct index strategy we talked about, and start building that up. Because that gives, especially for some clients, retirement. And if you have taxable money and IRA money, and you can blend that rate, we might be able to keep you in the 10, 15% tax bracket at retirement because we have flexibility on how we take the income. And that's a big thing for retirement.
Yeah, that's great. For those who are just starting, I would imagine that there are different strategies for different lifetimes in your earnings potential, right?
Yep.
For those of us who are just starting out, 401k makes sense, matching, and then putting the rest into maybe a taxable brokerage. What other strategies would you recommend as they progress throughout their earnings potential, all the way to maybe when they reach fire, or maybe when they're thinking about retiring and then post-retirement?
Sorry,
No worries.
phone drain there. There's when you get I always like to keep to the basics, right? Stocks and bonds, right? But once you start getting a little bit more net worth, you need to start looking outside of your traditional asset classes. And so that's where we're bringing some alternative investments.
Yeah.
And alternatives can be overly complicated as well too. But for the most part, we stick to what we're trying to accomplish there, which is get us diversification from stocks and bonds. If the stock market's down and the bond market's down like it was a couple years ago, we might have an asset that's actually doing okay. So we look for smoother returns, access to some investments we aren't able to get access to in the public markets. And so it just allows you to diversify outside of just being in a stock and bond portfolio. Because one of the things that we've noticed, is the last several market corrections we've had, stocks and bonds have both sold off at the same time. And so what used to happen is bonds were diversification.
Right.
That's not providing you diversification anymore. So I went through and said, okay, I'm looking at this. This is what's been happening. How can we protect our clients when this happens down the road with inflation rates going up? And so we went and dug into some alternatives, which provide low correlation to the stock market, low correlation to the bond market. And if the bond market's off, we have things that are actually bond-like investments that are still getting us 4 to 6, 7% rate of return, which is hedging against the bond volatility.
Yeah.
So we started adding that a couple of years ago more purposely to our portfolios to offset some of that risk and give some of our clients who have a little bit higher net worth some extra diversification from the portfolio. So that's one of the things I would look at is adding some true alternatives to the portfolio. And that doesn't mean, like I said, getting crazy into some of the specialty ones out there, just good core alternative investment. That's one thing. And then other than that, I don't go too much outside of that because I think the basics work, right? Keep it simple. And that's what we've stayed with our portfolios. There are a few things like private real estate that we've added some portfolios, but more than not, it's just things that are more diversification that aren't correlated to the stock market or the bond market.
Yeah. And we at Clive Capital are all about those alternative investments.
Yeah.
Yeah. And I'd be interested to learn more about those, whether it doesn't sound like they're public, which none of ours are really that public or public. But as I look at high net worth, ultra high net worth individuals where they invest their wealth,
Yep.
a lot of it is in those private equity, private investments.
Yep.
There's also businesses and the like. What have you seen as being like most successful? And then like, where do you hold those private investments?
All the ones we do have to be registered because of our licenses. So they have to be held for dealers. So we hold ours for real. A few of them were held direct at the fund companies, but it's all registered and held through like our back office. So it's reported, it's SEC regulated. It's not like a unregulated fund, like a Bernie Madoff fund. These are all being regulated by the SEC. So they're held at our back office. And one of the ones, which I won't mention any name, everyone's investing in the Mag 7. So the NVIDIA, Apple, the Amazons. Well, this company that we use does the Mag 7 in private investments. So it's like the Andurils, SpaceX, OpenAI.
Got it.
Stuff that you don't have access to on the public markets. So we're able to get into it through the private markets. They're buying it through the secondary markets that are out there. There's another company we use that goes in and they buy small businesses. They bring their management team onto it to help those people who are small businesses retire, and then they just strip cash flow out of it. And you're looking at a 2% standard deviation over the last 15 years, which standard deviation is a measure of risk, and 2 is very low. And they've averaged 9% per year. I'll take that all day long.
Yeah.
It does no correlation to the stock market, which is great. So those are some of the things that we've used that we've really liked and helped diversify portfolios. But I always tell my clients, which is not what I do. I know you mentioned it when you did your opening. If you get somebody that sells a business and has high net worth, or they've got options or RSUs from their company and they've liquidated and have cash, as long as you don't mind doing it, owning real estate is a great diversifier to the stock market, right? So I always look at it as a really good stool. You have your stocks, your bonds, and your real estate. And if the real estate market's not doing well, the stock market and bond market should be doing well. Stock and bonds, they just work well together. And real estate provides some great diversification for some clients. So you get some income, it's not, say real estate's a passive income driver, right? But it's not passive if you're buying it. You got stuff you have to do and be on top of, but it's a great write-off for taxes, and especially if you can qualify as a rep, a real estate professional, and you can take that bonus depreciation and use it against your income. That's a great strategy to reduce your income level if you have some decent net worth. And then again, generate some income on a monthly basis that's coming in for diversify from your W-2 job.
Yep, I love that. How should someone think about, and I'm thinking again, mostly tech professionals, but other professionals as well, where they have a major liquidity event, whether it's stock vesting or business
Yep.
sale or inheritance. What should they be thinking about from both a tax strategy perspective as well as investing that now liquid money? Where should they
Yeah.
invest at?
Typically, it's a liquidation from an RSU or an options. They've already kind of have to deal with the taxes anyway because they don't have much control on that. Inheritance comes in. Most of that inheritance should be tax free because it's paid by the estate. So they usually what happens, they get this lump sum of money that they now have that all of a sudden, okay, I've got all this cash and what do I do with it? So the first thing I always tell people is before you buy anything, build out your plan. So we start building out a financial plan first. And we look at, okay, well, now you got this money. Do you need income from it? How long do you have any liquidity needs? Are you going to have any purchases in the next couple of years? Maybe if you're a business owner, you sold that business, are you going to start another business in a couple of years? And so we need to make sure we understand what the goal is with those funds first before we even start talking about any kind of the investments, the taxes and how we manage the taxes until we know what the goals are. So that's step one for us is figuring out the goals and what the plan is. And then we start digging into the details of where we should allocate these funds. If, for an example, you got a guy who retires and they need to live off this money for a period of time, what we want to do is we want to time our assets to our time horizon, right? So if you need money and you're living off it, like just make it simple, it's $1,000,000 that you inherited and you want to take out $50,000 a year, I need to set aside $250,000, $300,000 in a more conservative bucket that we can draw out $4,100 a month out of it, right? Give you that $50,000 a year. And I can't take risk of that because that's an immediate need. So that's got to be your short-term bonds, your CDs, your money markets and whatnot. But I know some of the other money I might not need for 5, 7, 10 years. I take more risk with that because I don't need it today. So if the market was to crash 20, 25% tomorrow, I'm okay because I got time on my side to build that to let that money recover and grow back. And then obviously then above into that, you have your longevity bucket. And that's your long-term invest in the stock market. Obviously, we don't want to see the stock market crash, but we've got time on our side to get our money back when the stock market does full crash and we're waiting for that recovery. Because sometimes the recovery can take a year to 2 years before we get back to even on the stock market. So you need that time where you're not selling those assets at a loss that you're never going to recover. And so that's why we kind of time your assets for time horizon is to make sure we're protected in case anything happens to the stock market that we're not expecting.
Yeah, that's great. Let's talk a little bit about asset location. It's one of those concepts that sounds a bit boring, quietly compounds over time, over the decades. Why is where you hold an asset sometimes more important than what you hold? And what's maybe an example of that?
I think if I'm answering this, what you're asking, it comes back to kind of the taxes a little bit too. If you're a 60% stocks, 40% bond investor, but you don't need any money right now off that, holding the bonds inside your IRA is better for you because you're not paying tax on an interest. That's kicking out $20,000, $30,000 a year of interest. If it's in your taxable account, you're paying $5,000, $6,000, $7,000 in taxes on that. Where if it's inside your IRA, you're saving the taxes. So strategies like that obviously are one thing to think about where you hold the assets. Now, obviously, if you need the money in your taxable account and you might have something come up for where you have a major purchase come in a couple of years, you need a plan for that and need that safer money in those taxable accounts. And you maybe buy a muni bond instead of a corporate bond. But for the most part, if you can build out your allocation and think about what your needs are, where each asset should be held, that's a big thing of where you hold the assets. The other thing, which doesn't really necessarily answer the question you had, almost all employers now offer Roth 401ks. And if you can't start saving for your outside your 401k assets in your low tax bracket, you should probably not worry about taking that tax deduction today with the traditional 401k, pay the tax on that money, put it in the Roth 401k and let that thing grow for 15, 20, 30 years for you, tax-free and come out tax-free.
Yeah.
That's how when you get to retirement, now you have some flexibility with what you take out because that Roth money comes out tax-free in retirement. You can blend the tax rates again. So that's one thing to think about. And even some of my high earners, where we look at it, where if a Roth 401k is an option inside their plan, you look at it and okay, it might not make financial sense to do the Roth 401k because you're giving up, in the state of California, you're giving up 40% of a tax write-off for taking that deduction for traditional 401k, but you can control your taxes down the road, right? So if taxes keep going up, it might be better to sacrifice that tax deduction today, just knowing that it financially doesn't make sense today, but 15, 20 years ago, or from now when you retire, that Roth 401k is worth $1 million, $2 million. Now, when I'm in retirement, I'm not worried about what's going on in Congress and what they're going to do with the tax rates because I can control that with my Roth 401k. So some of those little things like that, where, and that doesn't really answer your question about how do you allocate them. It's the decision making on how you allocate the funds you're putting into root savings.
Yeah, that's great. Thank you for that. On the topic of maybe 401ks versus Roth versus traditional, I've heard a lot about Roth conversion, 72T. When should investors start thinking about doing that? And where does it make sense? Where doesn't it make sense?
Yes, I think it all depends on where you are income level wise, right? For a lot of my clients, when we look at Roth 401, and there's a calculator on my website we use to kind of give a basic overview. Then we go into the financial planning tool and do an actual Roth conversion to see what the actual cost is. But if you're a higher income earner, it's tough to convert to Roth because everything you're converting is going to be in California, 40 to 43% taxes. You put $100,000 in, you're converting only $57,000 after taxes. You've got to make up that $43,000 for even get back to even from where you were before with the IRA. So typically when we see it is a low where somebody can control their income and they're in a lower tax bracket that year, then we might take them up to the 25% tax bracket with the conversion. We'll say, okay, you can convert $50,000 this year and it'll put you up to 25% bracket and then convert that to a Roth account. Or somebody in retirement and we're worried about required distributions at 73.
Yeah.
And so we might, again, because they're in retirement, we might take more money from the taxable account, keep their income level low that year and convert $150,000, $200,000 of their IRA to a Roth and stay in that lower tax bracket. So usually that's where we see it, like somebody can control their income, a newer investor who doesn't have as much income and they can convert it to a lower tax bracket, or those retirees that we can be flexible with where their income comes from and convert it. I do have some clients that are older that they have converted to a Roth account. And they're not, and it doesn't make sense. They're paying a big tax on it. And I've explained this to them, but we're doing it more for estate planning because they're going to take it. They've got enough assets to live on. It's their legacy bucket, right? And it's going to go to their kids. And so they're wanting their kids to inherit this money tax-free where they can take distributions out of the account, the Roth, for their required distributions and not pay tax on it.
Yeah.
So it's like they're paying the tax for them and the kids are going to get it without paying the taxes. So they do some estate planning as well too.
Yeah, that makes sense. One account that I have not really used just because I haven't really qualified for, but it's the HSA.
Yeah.
And what do you think about HSA as an account, a holding account for?
I love HSA.
Yeah.
Unfortunately, I'm in the same spot as you. Our plan provider doesn't have very good options for HSAs. But if you have the option for it, I think it's a great tool. You put that money aside. And so, obviously, if you need it for medical expenses today, you use it for your medical expenses. So it goes in tax-free, but it's used for qualified medical expense. It comes out tax-free. So it's a great way for tax savings and a great way to take care of some medical bills. What I like for people to do, though, is if they can pay their medical expenses today, they don't even touch the HSA, let that thing grow. I had an HSA in an old firm, and I only had it for 3 or 4 years before it was removed. But I think I put in $7,000 or $10,000 over the couple of years I had it. It's worth like $65,000 now. And so when I get to retirement, it's just another tool for me to use to help with my tax savings and retirement to cover some of my medical expenses.
Yeah.
So if you got the option and you put it away, I think it's a great tool.
Let's switch over to charities now, charitable strategies, charitable giving, one of the areas where I think most people really don't think about, but it leaves enormous tax efficiency on the table. How should they be thinking about that? What are some common mistakes or maybe misperceptions about charitable giving?
For the most part, it's can you write off the charity now are you doing standard deduction or not? Because that kind of hurt with the tax law changes. But if you can do a charitable contribution, especially if you're younger, just giving to the charity as a straight charitable donation comes off your taxes. So that's easier. I think it gets more complicated when you're talking about somebody who has a liquidity event and they sold a business and now they have a tax bill. So how do we plan? And we want to give to charity. So how do we plan for that charitable contribution and save on taxes? And so there's strategies out there with charitable remainder trusts, which are great strategies where either the charity gets the money at the end after you've taken income off it, or the charity gets the money today and you get the money after a 15, 20-year period, it comes back to you, right? There's some estate planning tools you can use to give to charities and save on taxes. I think the easiest thing you can do is a donor advice fund. So a donor advice fund, we use Fidelity typically when we use it. We also use a plan called, I'm drawing a blank on it, iGift. which is a little more flexibility on the investments you can hold in there. Whatever you put into it is a write-off on your taxes this year. And what I like about it and what we use for some clients is we use it as like a charitable foundation, right? Instead of setting up a charitable foundation where you have to have a board and documents and it's expensive and you have to have record keeping, I tell my clients, just put this in a donor advised fund. And each year or even every quarter, every year, depending on what your schedule is, get together with your kids and say, okay, we've got this amount of money in a donor advised fund. And because you don't have to, you put in $100,000, you don't have to give $100,000 that year. You can let that thing grow too for you. But let's say $100,000 goes in and we're going to give $15,000 this year. And so make it a family thing because now your kids, you sold your business, you've got this net worth, get your kids involved in this. And so the kids would sit around with the parents, say, okay, what charities do we want to get involved in? And then they pick charities and they talk about why they like those charities and present like a little thing to their family about why they want this charity. And it's a great family thing to discuss it and keep the kids involved. And so we use donor advised funds as like a charitable foundation.
That's great. That's great. And it's primarily, as I understand it, used as a bunching strategy. So instead of contributing to a charity and then not exceeding the itemized deductible amount, really the standard deduction amount, by using a donor advised fund, you can exceed that amount. And then, that's great.
Yeah, you can put as much as you want, but you can put in a couple $100,000. You put in $10,000 if you want.
Okay.
And then again, you don't have to give to charity that year either. You can let that thing grow and give a charity down the road. I got some clients who put money in every month to their donor advised fund, and they just keep building that up as a charitable for them when they want to start giving to charities later on. They have that pool they can start giving to the charities of their choice.
I've also heard about qualified charitable distributions, and for investors over 70 and a half, it is useful. I don't know much about it.
Yep.
Do you know much about that? And how it interacts with required minimum distributions?
Yeah. So now it's 73. So it used to be 70 and a half. But now
73, okay.
Yep. So required minimum distribution is now 73. So you have to be in that phase of your life where you're taking required distributions. And so a lot of those clients they don't itemize their deductions anymore. So they use standard deduction. If that's the case, you cannot write off your charitable contributions. So what we'll do, and actually we just did one a couple hours ago, is a client will come in and say, hey, we want to give $10,000 to the church. And so you take that distribution from the IRA, send it to the church, and it comes off their taxes. And it satisfies part of the required distribution. So if you have to take $30,000 a year for your required distribution, you give $10,000 to the church. Well, you take your 30, you take 20 that you pay tax on, 10 goes to the church. It saves you $3,000 in taxes. So it's a way during retirement when you don't qualify for itemized deductions to still give money to charities and get the write-off for your taxes.
Got it.
It's a great tool.
Okay, perfect. After 20 years of watching high earners, what are maybe 2 or 3 tax mistakes that come up over and over again that you've seen and that are expensive, and maybe that are pretty easy to fix?
Yeah, I don't know how many, I would say I don't see how many tax mistakes I'd see. Because for the most part, if most of my clients, they work with their CPAs and they have a good tax strategy. I think the only thing I can think of is, like, for example, here's a good one. I have a client who 2 years ago sold their business and they sold it in October. And which means that the tax bills due they only have until December to get all their stuff put together to save on taxes for the business sale. So their big mistake was, they knew they were selling the business a year before that, but they did zero planning up to that point until they sold the business. And then they're scrambling to do their tax, like to put all their tax planning in place in the last 3 months of the year. And so they got stuck with not being able to take advantage of some of the different things you can do when you sell a business or have a liquidity event to do the tax planning ahead of time to save on those taxes. And so that's one I can think of where they didn't do their tax planning before the event happened. Yeah. They tried to do it after and they ran out of time. Yeah. So it probably, if I'm going back to that case, it probably cost them $1.5 million, $2 million in taxes.
Wow. Okay.
So it was a big thing. Yeah. And I know we talked to them about it ahead of time, and we talked to them about working with an attorney to get this in place, and we introduced it to them, and they just kept putting it off because they were busy with the sale. Sure. And they never did it. And then they got stuck. Yeah. So that tax planning.
Looking back on that, what could or someone in their position have done differently?
I think when like I said, they sold in October. We started engaging with them probably in February or March to get stuff in place. They should have done the planning 2 to 3 years ahead of that. Yeah. Because if they knew they're going to sell, which they've been trying to sell from us talking to them, they've been trying to sell for a couple of years previously. They're going to sell. You should be getting your ducks in a row to be ready to get these things in place, these structures in place to take advantage of the tax savings that are out there. And there's some, and the other thing that happens too, this is the other one I was thinking about, but because I was thinking of this client I'm talking about is when we're talking to him, our thing is, because he's a younger client, is the more you try to save on taxes sometimes, where you get really complicated with these tax planning strategies, and you lose control of the asset. And so we've seen a couple of clients that have sold where they went through these. This one guy paid $65,000 to an estate planning attorney. And I'm like, you're overcomplicating your life. Like, you do not need to do all this stuff.
Yeah.
And he went through and he did it, and he sold his business, and now he's stuck in these trusts he can't get out of.
Right.
And so he needs the money, but they're irrevocable. And there's gotta be a fine balance between how much you pay in taxes and how much you try to defer or get to remove from your tax bill. And sometimes it makes sense just to pay the taxes and stay more liquid too. I think overcomplicating your tax strategy is one thing I've seen some high earners do and cause some problems. And then not planning for the taxes when you know you have a liquidity event coming up, and not being prepared for when that happens and running out of time to get your tax strategy in place. And so I think those are the two big ones I can think of. And those have all happened in the last couple of years with some of my clients.
Yeah. Gosh. Wow. Similar type of question, but along the lines of W-2 versus business owners. Business owners have a lot of tax strategies, tax entitlements that the tax code gives them. Whereas W-2 earners, they really don't have a whole lot of them, or very similar ones. What should those W-2 earners be doing that maybe not have the same type of tax entitlements, or maybe they should be starting a side business? What's your recommendation there?
Yeah, that's the guy for all my W-2 earners. That's the number one question I get. And there's not a lot you can do. With your W-2, you got your 401k. Sometimes the company will offer a deferred comp where you can put money aside into deferred comp. Right. And that's a nice way to get some of your taxes deferred. But W-2, you're stuck. The only thing you can do is, like you said, get a side business. But that side business has to get income. So if you don't have income to generate off it, you're not going to offset other income because it's just a passive investment strategy. But yeah, W-2 is tough. And which is why, for me personally, I was always a W-2 employee. And one of the reasons I wanted to create my own company is I wanted to be a 1099. I wanted to be a business owner because now my cell phone, my cars, my gas, my insurance, my Wi-Fi, state of California, I can write off my state tax for my business. Those are all huge tax savings that you don't get being a W-2 employee.
Yeah. Yeah.
But yeah, W-2 is tough. There's just like that. I get a lot of high earners, and that's their biggest concern. And just, there's not much you can do.
Yeah. Yeah. So our audience is fairly sophisticated about really earning money, but less so about deploying the money. So as they think about maybe retirement, moving toward FIRE, what does a smart capital deployment strategy mean for you? And I'm thinking like sequencing. When do you pay down debts, taxable investing, and alternatives and the like?
Yeah, that comes with the financial plan, right? One of the things, like, depending on there's good debt and there's good debt and bad debt.
Right.
A mortgage at 3% is good debt, right?
Yeah.
A credit card at 24% is bad debt. Right? And so if you got stuff that's paying 8, 10, 12% on your interest, well, if you pay that off, that's like an 8, 10, 12% return on your investment, right? And so I tell people, don't even think about starting to put money aside in an account if you got bad credit card debt or bad debt that's charging interest, because the market can't guarantee a 10%, but you pay down a credit card that's earning 10%, that's a guaranteed return.
Right.
And so I always say, get your ducks in a row first with make sure you have your living expenses taken care of. Make sure you have an emergency fund taken care of. Once you have those in place, then you go about start investing, right? And then you start with the 401k. Is it a Roth 401k or a regular 401k? You start maxing it out. You got extra money coming in. Okay, let's start with the taxable account. Let's start putting money in the taxable account. Do I have any expenses coming up I need to save for? If not, let's put this more towards long-term money, put it in the stock market. Okay, now I've built up $300,000, $400,000, $500,000 in this taxable account plus my 401k. Well, maybe I need to start putting money into an alternative investment to diversify my holdings, right? So you just kind of keep building on it as you go. And that's where like a financial planner and building a financial plan help people, because they kind of guide you along with what's out there. I'm thinking of a client I just brought on here recently, and he's a high net worth client. He's a smart guy, but sometimes this is going to sound bad, but they don't know about investing, right? And so they start chasing those shiny objects. Oh, this is a private investment with a Series A investor. Let me give $100,000 of that. Oh, this is a private investment with a yoga studio you're building. Let me give somebody that. And because those returns look big, right? Those returns that you put $100,000 in, and if this works as expected, you get $1 million in 5 years. And 90% of those go bankrupt, right?
Yeah. Yeah.
Even 95%. And so I've seen several clients of mine get enticed by those returns, and those aren't core investments. Those are, you get all your fundamentals taken care of, you get your taxable account, your alternatives, you get your 4K, and that's the play money. So let's go on and invest this Series A that I think looks good, but knowing that chances are that's not going to come back, that's going to be a write-off for you. So, and that's maybe 5-10% of the portfolio that you can go out there and try to hit those home runs. And I've done it too. When I put money into Series A funds, and I would say 95% of them have gone bankrupt, but the 5% that did well have done really well.
Yeah.
But you just got to know that those are what you're getting into. But I got my other stuff taken care of. And so it's part of my financial plan. I know if I'm tracking and saving what I'm doing with my plan, I can play with some of this money out here, but you got to just be organized and disciplined on what your plan says.
Yeah. I almost think about it as like, you're almost a venture capitalist. You expect one out of every maybe 10, maybe 20 of these ventures they invest in will pop, but all the other ones would just fail.
And you got to be able to put money into them, otherwise you're going to get diluted, and
right.
so you got to be able to keep funding them. And so, you got to, that to me that's a play money that you can afford to lose.
Yeah, exactly.
But I had like the one client I was talking about, he put most of his net worth in it. And now we're looking at,
wow,
you're going to lose on most of the stuff, and you sold your business for a ton of money, and that's going to be all gone.
Yeah.
So,
wow. Okay. For those high earners that are approaching retirement, we're approaching their FIRE number, maybe not the typical 60, 65, 70 years old, but like younger.
Yep.
How should they think about the tax strategy shift as they are approaching? So maybe they're 1 year out, maybe they're 5 years out. What should they be thinking about, and what moves should they be making before they retire that they can't make after?
Yeah, that's tough, because if you're 1 or 2 years out, you're probably a little bit too late, I think.
Yeah.
It comes back to what we talked about earlier, is you should be thinking about your retirement 15, 20 years ahead of time and saying, okay, am I building up a taxable account, a Roth account, an IRA account, or even real estate where I got passive income coming in, and building different income streams. And do I have these different investments now? When I do retire, I can allocate to how much am I going to take from my IRA versus my trust account and keep that tax bracket low. So those take time to build, right? So those are things you work 10, 15, 20 years before you get to retirement. Mm-hmm. If you're in retirement, everything's in your IRA, you're stuck. There's not much you can do.
Yeah.
So I think at that point, it's too late. It should have been done before.
Yeah. We talked a little bit about this. If you have an RSU, that's one thing.
Yep.
I'm thinking more if you inherit money. So inheritances often you can't control them. Someone passes away, you inherit the money. What can you do as the person inheriting the money? What does your first 90 days look like? What should you be doing in order to protect the money that you just inherited? Yeah.
So that's where I think if you're not working with a planner, you got to get a planner, right? Mm-hmm. And you need to look down and say, okay, here's what's coming in and what am I getting? Because if you inherit an IRA, you have to take that over 10 years and there's not much you can do. So if you got $1 million IRA inherited, you're really going to take roughly $100,000 a year at a minimum that you're going to take out and pay tax on it, ordinary income. There's not much you can do. Real estate, a little different, right? Because, or money that's inherited from a trust or non-IRA assets, there you have a lot more flexibility, because most of that, like I said, that tax is paid by the estate. So it's not really about managing for the taxes. It's okay, I got this windfall. How do I not lose it? I see a lot of times when people get that windfall, all of a sudden their lifestyle creep goes up, right? Yeah. And so they inherit $1 million. And so I got this $1 million. And they start spending, and all of a sudden 5 years from now, they don't have $1 million anymore. And so it's more building a plan of like, how long will this money last? How much can I take out of this and still live and be okay without losing my inheritance, wasting my inheritance? And so I said it tax wise, I don't think there's much that you need to do or can do, because the estate's going to take care of most of that. It's more of like, how do I manage this windfall, and do I have a good plan for it? Yeah, it's good. It's good advice. Let's switch over to maybe working with advisors such as your team. Most high earners have a CPA. Maybe they have a financial advisor, maybe they don't. Maybe they have an estate attorney, maybe they don't. And they often don't talk to each other. How do you get them to talk to each other? Who's the quarterback of that team? Typically, we're the quarterback. A lot of times we have to refer out to a CPA and refer out to an estate planning attorney. So we kind of control the coordination between all three. if the client already has a CPA and estate plan attorney, what we ask is, do you mind if we reach out to and talk to them so we can all work together?
Yeah.
And nobody has a problem with that. And that's part of my job, right? I see myself as the center of the spoke to go out and talk to these different areas to make sure everybody's coordinated and working together. We make sure the CPA knows where we are income level wise for the portfolios. How much capital gains are we expecting to have this year? How much taxable income are we going to have this year? So we're constantly talking with the CPA so they know where we're at. I shouldn't say constantly, but every quarter, typically we're talking to CPA for people who need it. Some don't need it till the end of the year.
Yeah.
Estate planning attorneys, a little bit less needs on that, except for when we notice something's off. Hey, this is an old estate, and now we have the portability rules with estate planning. So you got an AB trust. You don't need an AB trust anymore. So let's get that estate plan updated. So let's coordinate with your estate plan attorney and make sure we get all the documents to them and they know exactly what you own and how it's owned and get those things updated. So we typically quarterback all that.
Okay. And we didn't really talk about protection of asset,
Yep.
but is there anything that individuals can do now to protect their assets? Or is that in coordination with you and the estate tax?
I always say I know enough about estate planning to be dangerous, right? And so I'll kind of give high level strategies on what needs to be done. And then we coordinate with the estate planning attorney. But in every state's different, right? So state of Washington, you don't necessarily need a trust. State of California, you need a trust. So it depends on where you're located, what kind of assets you have. But like I said, there's some states, like if you have any assets at all, you need a living trust.
Yeah.
If you own a rental property, do you own that individually or do you own an LLC? If you own a rental property, you should own that in an LLC. Right. So stuff like that is what we would look at, say, and make sure everything's coordinated properly. Even for like estate planning and beneficiaries, how are your beneficiaries held? Do you have that set up for how you want this to go to the next generation? And so those are all things that we talk about to make sure it's in place. And then and that's not, I guess, that really answer your question about protecting, but the LLC and the trust protects clients from certain situations for sure.
Yeah. We are getting to the top of the hour and we have some questions that we typically ask our guests. One is, describe a failure that you've had in the past, and what you learned from those failures that you're teaching to others now.
Yeah. So I think the biggest one is when we first start out in the market, which is pretty much 29 years ago, we overreact to the market. And we think we can do things to time the market or be smarter than the market. And that's just not possible. You can't do that. And so I always go back to, especially when I first started, is because my business is a lot of times psychology, right? We manage fear and greed. And I go back to 2007, 2008. And I had one client and in December of 2008, they're like, I can't take it anymore. I need this. The market's going down. I think it's going to keep going down. I just can't take it. I want to sell. And I talked to him like, look, it's not a good idea. Go through it. And he only sold 40% of his stocks to go into bonds. And he was right because the stock market dropped by 25, 30% after that. So from December to March 9th of 2009, that was a low point in the market.
Yeah.
If he'd have stayed where he was, he'd have lost another 25, 30% on his portfolio. But he didn't. He went to bonds and protected it. March 9th, the Congress changed rules on mark-to-market accounting and the market starts taking off. And for the next 2 months, it goes straight up. And he got back into the market where he put that money back into the market, probably June of that year. So June of 2009.
Yeah.
All my clients have stuck to the plan and we kept them in the plan. We kept them invested. We made little changes here and there, but we didn't get them out of the stock market. We kept them fully invested through the volatility. They got back to even within 2 years. He didn't get back to even for almost 8 years.
Yeah.
And I think we try to outsmart the market. We think we know more than the market, or we try to pick the hot stock or hot fund. And it's not how it works. You want to have tracking here. You want to be participating in the market, but the market's now 20%. Yeah, I don't like it, but I don't care because I'm a long-term investor and I know it's going to come back. And so I think that's the biggest mistake people make.
Yeah. Got it. That's good.
Or I make as a young advisor, right?
Yeah. And so that's the other question I was going to ask. If you go back to a 10, 20-year version of yourself, what advice in 20 years younger, what advice would you give yourself knowing what you know now?
Yeah, I think the biggest one is when you start out, you think it's all about picking the investments, right? Picking the stock, picking the funds. And that's not it. Our job is obviously to do our screening to make sure we pick good investments for our clients, but that's not what our job is, the main part of our job. Because if I'm an advisor and I pick ABC fund and I've done my job, my due diligence, and the guy down the street's a good advisor and he picks a XYZ fund, 10 years from now, we're gonna be in the same ballpark. My choice of my fund versus what he chose on his fund, if we're doing our due diligence, is not gonna make much of a difference for our clients' portfolios. Building the allocation, matching the risk to the client's risk tolerance, following the financial plan. That's the key to success in this business. And it's the key to success for our clients. It's not picking the funds. It's not
Yeah.
picking the hot stock. That stuff's secondary. It's the allocation of the plan is what makes their client successful.
Got it. Okay. That's good. I like that advice. I think the last couple questions, how do you give back to your community?
Yeah. So I got 4 kids. So I don't have a lot of
Busy.
but what we do is we do a lot of donations. There's 3 big charities we work with: the Susan Komen Breast Cancer, Helen Woodward Animal Center down here in San Diego, and then Rady's Children's Hospital here in San Diego. Those are the 3 big ones. We used to do more with the military as well, but the guy I used to work with in that area, he's no longer in that business, and I haven't found a military charity we work with. So we do a lot of stuff like that. And we do a lot of donations. We did a company event a couple of months ago where we went down and fed the homeless. So we packaged food for the homeless.
Okay.
And so our goal is to do more of that stuff going forward is as a business is to every quarter find a charity and go as a team, go down there and work on that charity. But for the most part, we try to participate in the charities we care about and to go to their events that they have and to be part of it. We had my kids for a children's center. Some of the dorms, we'll call it, because they are living in these dorms, were outdated and old. And so we went down and painted the dorms. So we try to get involved in stuff with that. Yeah, to be involved in the community.
Yeah, that's great. That's wonderful. Thank you for stating that. For those interested, what's the best way to reach you and learn more about what you do at Sea Point Wealth Advisors?
Yep. So my email address is chad@seapointwealth.com. And it's Seapoint, SEAPOINT wealth.com, not C like letter C. And our website is seapointwealth.com.
Got it.
So obviously that email comes directly to me. I answer it. I have a team of advisors here that we work with our clients with. And on our website has information about our company, how to contact us, how to contact different advisors, some of the awards we've won, and about our strategy as well too, and how we manage money.
Perfect. Thank you. And thanks for the conversation, Chad. Learn a ton of information. We'll include Chad's contact information and all that, the website, other information in the description of this podcast episode as well. Don't forget to like and subscribe to our podcast on whatever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. Until next time, keep learning to invest for generational wealth.